Corporations can generally be broken down into two categories. There are C corporations or regular corporations. Think of Apple or Johnson & Johnson that are just referred to as corporations. And an S corporation. A C corporation is treated separately from its owners in all respects, including income taxes, unlike an S corporation, which we'll get into later. The shareholders are not liable for any debts of the corporation, so the owners have liability protection. A corporation, however, pays taxes on its own income, and after paying that tax, if a corporation pays dividends of after-tax profits to its shareholders, that dividend is also subject to tax at the individual level. In this way, the corporation is subject to double taxation, once on its earnings and at the corporate level, and again when the shareholder receives a dividend. Now, despite this considerable tax disadvantage for a new business, corporations are often the entity of choice for those who seek to raise significant capital through third-party investors. S corporations remain a very popular entity type, particularly for small businesses. They are also corporations that can have more favorable tax treatments than a regular corporation. The shareholders have liability protection just like in a corporation. However, there are no corporate level tax, and the income flows through to the individuals so that they pay tax on their own share of the company's earnings on their individual income returns. They also receive some favorable tax treatments in respect to Social Security and Medicare taxes, which, depending upon the profitability of the entity, can be substantial. Now, the Social Security and Medicare tax savings are not available to all other types of flow-through entities, partnerships, and LLCs. So this is still an entity type that is very common and popular. There is also a provision in the Tax Cuts and Jobs Act that potentially allow a 20% deduction called qualified business income, or QBI, to the shareholders of the company. QBI is complex, and not all businesses qualify for the QBI deduction. Shareholders would need to discuss QBI in detail with their trusted advisor. If a business does qualify, a simple example of this would be if you are a single shareholder of an S corporation and the bottom line taxable profit that you would need to report on your personal return is $100,000. You, as a shareholder, could potentially receive a $20,000 deduction on that $100,000 of income, effectively paying tax on $80,000 of income rather than the $100,000. Despite the popularity of S corporations, there are limitations to which that can be very prohibitive depending upon the intent and plan of the business. Only one class of stock is allowed in an S corporation, and as a result, all shareholders are treated equally with the ownership percentage dictating the distributions of earnings and profits. Not all tax availability, but distribution. You cannot take money out of an S corporation in any other proration other than your ownership percentage. That can be problematic in terms of governance. Additionally, S corporations who have restrictions on who may be shareholders and how many shareholders there are may be all shareholders must be U.S. citizens, and only certain trusts are eligible shareholders of an S corporation. And there can't be more than 100 shareholders. Partnerships and corporations cannot qualify as shareholders. So while these factors are not necessarily an issue for all small businesses, if the company anticipates that it's going to be raising venture capital money in the future, an S corporation may not be the best choice. A general overview of tax law can be very complex, and we advise that anyone considering choice of entity to consult with their trusted advisor.